Evolution of payment instruments from cash to digital wallets. Welcome back. In this chapter, we're diving into the fascinating evolution of payment instruments. Payment instruments are the tools we use to transfer money: cash, checks, credit cards, mobile wallets, and beyond. Each instrument has shaped how we transact, and its evolution reflects society's needs, technological advancements, and economic trends. By the end of this chapter, you'll have a comprehensive understanding of the key payment instruments, how they emerged, and why they remain relevant, or not, in today's rapidly changing world. What are payment instruments? A payment instrument is any method or tool used to transfer value from a payer to a payee. These instruments have evolved over thousands of years, driven by the need for efficiency, security, and convenience. From carrying bags of coins to tapping a smartphone, the tools we use to pay have come a long way. To understand this evolution, let's start with the most traditional instrument, cash. The era of cash. The birth of coins and banknotes. The story of cash begins with coins, first introduced in ancient Lydia around 600 BCE. Coins quickly became the dominant medium of exchange due to their durability, portability, and standardized value. Over time, societies began using coins made from precious metals, like gold and silver, which had intrinsic value. Fast forward to the Tang dynasty in China, where the first paper money appeared in the 7th century. Banknotes were initially used as receipts for deposited coins, but they eventually became a standalone form of currency. In Europe, paper money gained traction in the 17th century, with countries like Sweden and England leading the way. Cash as king. For centuries, cash remained the dominant payment instrument, offering simplicity and universal acceptance. Even today, cash is widely used, particularly in regions with limited access to digital infrastructure. Advantages of cash: universal acceptance, no need for technology or accounts. Anonymity, transactions don't leave a digital trail. Immediate settlement, no intermediaries required. Disadvantages of cash: risk of theft, carrying cash can be unsafe. Cost of handling, printing, transporting, and storing cash is expensive. Inconvenience: handling exact change or large amounts is cumbersome. The age of checks. By the 17th century, checks emerged as an alternative to cash, driven by the growth of banking systems. A check is essentially a written instruction to a bank to transfer money from the payer's account to the payee's account. Why checks became popular? They allowed people to make payments without carrying large sums of cash. They were particularly useful for long-distance transactions. Businesses adopted checks for payroll and large transactions. Limitations of checks. Processing time. Checks often took days to clear. Fraud risk, forged or bounced checks were common issues. Decline in usage. With the advent of faster and more convenient payment methods, check usage has declined significantly in many parts of the world. Today, checks are still used for specific purposes, such as business-to-business transactions and legal payments, but their overall role in payments is diminishing. The credit card revolution. The birth of credit cards. The modern credit card, as we know it, began with the Diners Club card in 1950, which allowed members to charge meals and entertainment at select establishments. In the 1960s, Visa and MasterCard entered the scene, creating a global network of credit card acceptance. Credit cards introduced the concept of buy now, pay later, where cardholders could make purchases on credit and repay their balance later, often with interest. How credit cards work. When you swipe, insert, or tap your card, the payment is routed through a network of entities, including the merchant's acquiring bank, the card network, like Visa or MasterCard, and your issuing bank. If approved, the transaction is completed and the merchant receives the funds. Advantages of credit cards. Convenience, easy to carry and widely accepted. Credit access enables purchases without immediate funds. Rewards and benefits, cashback, travel points, and purchase protections. Challenges with credit cards. Debt accumulation, high interest rates can lead to financial trouble. Fraud, credit card data is a prime target for hackers. Fees, merchants bear the cost of interchange fees. The rise of digital payment instruments. As technology advanced, the payments industry began transitioning from physical to digital instruments. Let's explore the key milestones in this digital revolution. 1. Debit cards. Debit cards emerged as an alternative to credit cards, allowing consumers to make purchases using their own funds. Unlike credit cards, debit cards don't involve borrowing money. Key features: instant deduction from the payer's bank account, lower risk of debt accumulation, often linked to ATMs for cash withdrawals. 2. Online banking and bill pay. The advent of the internet in the 1990s brought online banking to the forefront. Consumers could now transfer funds, pay bills, and manage their accounts without visiting a bank branch. Impact: banks became digital-first institutions. Payments like utility bills and subscriptions became more efficient. Reduced reliance on checks and physical bank visits. The mobile payment revolution. 1. Mobile wallets. Mobile wallets like Apple Pay, Google Pay, and Samsung Pay have redefined convenience. They allow consumers to store payment card information digitally and make payments using their smartphones. How mobile wallets work. Consumers link their payment cards to the mobile wallet. Payments are made using near-field communication, NFC, or QR codes. Tokenization ensures that sensitive card data is replaced with a secure token, enhancing security. Advantages: convenience, no need to carry physical cards or cash. Enhanced security, biometric authentication and tokenization reduce fraud risks. Integration, many wallets support loyalty programs and transit payments. 2. Peer-to-peer, P2P payments. Apps like Venmo, PayPal, and Zelle have made it easy to send money directly to friends and family. These apps are particularly popular for splitting bills, sharing rent, and sending gifts. Key features: instant transfers between users. Integration with social features, for example Venmo's payment feed. Low or no fees for domestic transactions. The emergence of cryptocurrencies. Cryptocurrencies, led by Bitcoin, represent a new era of decentralized digital payments. Unlike traditional currencies, cryptocurrencies are not issued or controlled by central banks. Instead, they rely on blockchain technology, a distributed ledger that records transactions transparently and securely. Advantages of cryptocurrencies: decentralization, transactions don't require intermediaries like banks. Global reach, cryptocurrencies can be used anywhere in the world. Security, blockchain technology makes transactions tamper-proof. Challenges with cryptocurrencies: volatility, prices can fluctuate wildly. Adoption, many merchants and consumers are hesitant to use them. Regulation, governments are still figuring out how to regulate cryptocurrencies. Contactless payments and beyond. The COVID-19 pandemic accelerated the adoption of contactless payments as consumers sought safer ways to pay. NFC-enabled cards and mobile wallets made it possible to complete transactions without physical contact. Advantages of contactless payments: speed, transactions take seconds. Hygiene, reduces the need to handle cash or touch payment terminals. Security, advanced encryption protects transaction data. The future of payment instruments. The evolution of payment instruments is far from over. Here are some trends shaping the future. Biometric payments, using fingerprints, facial recognition, or even heartbeat patterns to authenticate payments. Wearable payments, smartwatches and fitness bands that enable payments. Embedded payments, payments integrated seamlessly into apps and devices, such as Amazon's one-click checkout. Central bank digital currencies, CBDCs, government-backed digital currencies that could replace traditional cash. Conclusion and preview. The journey from coins to digital wallets reflects humanity's relentless pursuit of convenience, security, and efficiency. Each payment instrument has played a crucial role in shaping commerce, and as technology continues to evolve, we can expect even more innovative ways to pay. In the next chapter, we'll explore the infrastructure behind these payment instruments, payment networks. You'll learn about the systems that power transactions, from card networks like Visa and MasterCard to emerging blockchain networks. Thanks for joining me, and I'll see you in the next chapter.